Live from the Business RadioX studio inside Renaissance Bank, the bank that specializes in understanding you. It's time for North Fulton Business Radio.
And hello again, everyone. Welcome to another edition of North Fulton Business Radio. I'm John Ray, and folks, we are broadcasting as usual from inside Renaissance Bank in beautiful Alpharetta. And if you're looking for a bank that's rated in the top 10 for Forbes magazine, not just in the Southeast, but nationwide, well, here they are, Renaissance Bank. And I think they're there, this is my own opinion from my dealings with them, because they're big enough to handle pretty much any need you can throw at them, but small enough to do it in a personal way. If that's the kind of bank you're looking for your business, then I suggest going to renaissancebank.com, finding their local office, and giving them a call. And I think you'll be glad you did. Renaissance Bank, understanding you, member FDIC. And now I want to welcome Jeff Hawkins. Jeff is with Carr, Riggs, and Ingram. Jeff, welcome.
Good morning. It's great to be here.
Yeah, it's great to have you here. So let's talk a little bit about you and Carr, Riggs, Ingram. How are you serving folks out there?
Sure. So, Carr, Riggs, and Ingram is a traditional accounting firm. So, we serve people in a capacity of tax, auditing, and consulting. Where I come in is in the consulting front. So, and that more specifically would be transaction advisory. So, a lot of people ask, what is transaction advisory? So, really what it is, as you're going into a deal, there's all types of diligence, right? Mm-hmm. There's financial due diligence, legal diligence, environmental diligence. Well, we kind of focus on the financial due diligence. So the way deals are really structured and valued is that people are looking for an adjusted EBITDA number to then kind of go to market and advertise a different multiple, right, for whatever industry you're in. So as you can imagine, as you're going through that process, you're dealing with sophisticated professional people on both sides. So, what you need is just like you need a deal attorney, a deal attorney, mm-hmm. You'd also need a deal accountant, right? That understands, what the structure of a deal may look like, that the tax impacts of a deal. Mm-hmm. Another thing that people kind of overlook as well is the working capital that has to be transitioned to the new owner at closing. And what does that look like? What gets paid off at closing? What continues on?
Gotcha.
A lot of times it's pretty straightforward with debt. I mean, obviously it gets paid off, but we encounter things like customer deposits where you receive things in advance. The deal's going to be cash-free, debt-free. So how do we handle that, right? And each side's going to argue that differently.
Right, of course.
So, and this is where it departs from just normal GAAP accounting, is where, the people are, the buyer's going to pay what they pay for it, mm-hmm. and they're going to take the terms they're going to take. So you have to kind of help walk people through that. So again, it's accounting, but it's also kind of helping them understand the economics of the transaction.
Now, I would imagine that you're working with businesses that really have reached a certain level of size and maturity. That you're not working with small businesses. So let's get some definition around this. I mean, and talk about the size of businesses that you're working with.
Sure. So that's actually one of the unique things about Carr, Riggs, and Ingram is we are a top 25 accounting firm, mm-hmm. but we've grown a lot through our own M&A, which means we have a lot of local office practices that have merged in. Mm-hmm. So we are squarely in the middle market to lower middle market. So while we definitely, deal with companies of certain level of maturity because they're ready to be sold and they have some sort of value, we deal with companies that can be as low as 10 million in revenue up to about, half a billion in revenue.
Wow. Okay. So I want to dig more into some of the particular aspects of your practice, but before we do that, let's talk about M&A generally. Let's look at the state of the M&A world, maybe, and maybe you can make some comments on that generally.
Sure. So it's actually been a really interesting ride for the last 2 years, as I'm sure a lot of people have heard. Mm-hmm. During COVID, what happened was a lot of the PPP money and the other CARES Act money wasn't available to private equity owned companies because they grouped those people together as affiliates. Mm-hmm. And so they were above the employee limit. So a lot of, that transactions kind of hit pause and they had to go back and and be stewards of the companies, right, and help steer them through COVID without some of this additional money. Well, as soon as that kind of relieved itself a little bit and people were like, okay, COVID's not going to completely destroy the economy.
Right.
And so people kind of came back into it with a flood, right? Mm-hmm. And so there was a lot of pin-up money and pin-up transactions that kind of had to flow through. So that's really what happened in 2021. Mm-hmm. And so far in 2022, we keep expecting things to slow down, but in general, it's still higher than activity was in, 2018, 2019. So again, not as much as 2021, but the activity is still there. So, one of the main reasons for this is there's a lot of dry powder on the sidelines, and, to kind of define dry powder, it's the money that's been raised by the general partners, the fund managers that's ready to be deployed. Mm-hmm. And so that's at an all-time high still.
Right.
And so, even though inflation's happening and interest rates are rising, interest rates are still relatively cheap, even though they're rising. So, that's the reason we see that this is still happening. And then, one of the other big factors is that, the baby boomers generation is going to be transitioning out over the next 10, 15 years. And what we've seen is those businesses are being sold into private equity, family offices, as opposed to inside the family. Mm-hmm. And so that's going to kind of drive some of the demand, I believe, even if the economy starts to falter somewhat.
So, Jeff, you talked about how 2022 is not quite as robust as 21. Some of that, though, has something to do with, we were talking before we came on the air, there was a whole lot of deal activity right before year end and pressure to get deals done before year end, right? So there was a little bit of a spike there at the end of 21, right?
That's right. Yeah. So if you remember back to the middle of 2021, everybody thought the capital gains tax rate was going to change. And so that's the tax that gets impacted here when you sell your company. And so everybody kind of rushed to the table to say, we got to close before the year end to make sure the rate doesn't go up 5-10%, because on a 20, 50 million, $100 million transaction, that's very significant, right?
A lot of money.
And so, but interestingly enough, right, it didn't change. Mm-hmm. And so a lot of that, but again, people still kind of rushed to close towards the end. So really, like from June to December of 2021 was an all-time high for basically everybody.
So we're here in 2022, and of course, since year end, we've had higher inflation. We've got a war in Europe. We've got all sorts of an economy that's potentially has a recession baked into it somewhere, a falling stock market. How's all that together? Easy for me to say. How's all that together impacting the M&A market? What do you see for the rest of 2022?
Sure. So, again, I think deal activity is going to stay high. Mm-hmm. I think what's going to change is the valuations are going to start to come a little bit back down to earth. Mm-hmm. Because again, all the things you mentioned are economic limiting factors. Mm-hmm. And so, but again, this all-time high happened during a period of COVID of huge uncertainty. So, again, it's unpredictable, right? I don't think anybody would have predicted that it would have happened last year. And then again, every time that I keep hearing that it might slow down a little bit, nothing from our viewpoint indicates that it's going to slow. And like I said, it's an interesting time because, people who've run their business for 30, 35 years after going through COVID, after going through labor constraints, after going through supply chain issues, inflation, a lot of people are, what we've seen are they think this is the time to leave, right? Mm-hmm. And the valuations are high. So again, it's kind of been a perfect storm so far. So, from my perspective, I believe 2022 will finish strong. And then as the economy appears to keep sliding like it does, 23 and on may be a little bit different story.
Yeah, I can see that. Folks, we're here chatting with Jeff Hawkins. Jeff is transaction advisory partner with Carr, Ingram here in Atlanta. So, Jeff, what I was, we were chit-chatting about baby boomers and how we've been waiting for the baby boomer changeover, for them to divest their businesses for years. It looks like that is finally maybe at the cusp of happening with all this recent activity.
Yeah, that's right. Again, it's, because because of our local client base, from how our firm has been built, again, we work with a lot of original owner founded businesses. And yes, so even if they're not large enough to maybe warrant a lot of financial due diligence, there's still some tax planning that needs to be considered from their perspective. And so, yeah, we're seeing an all-time high from our perspective. And again, it's, what we've had to invest in this practice heavily to grow, to meet the demand. And so again, it's just showing us that things are transitioning. And also in our audit base, a lot more of those companies are now owned by, it's not the founder owner anymore, right? There's some sort of money in there from maybe a mezzanine debt fund or a private equity group or a family office. So we're seeing it across the practice.
Now, one of the things that that you've got some interesting thoughts on is the impact of labor constraints on professionals in the M&A industry, whether they're investment bankers, accountants, what have you, CPAs. Say more on that and what you're getting at there.
Sure. So, what we encountered, obviously, as a CPA firm, was one of the biggest rushes we've ever seen in this space. Where we benefited is that our practice is a little bit newer, and so we've been a little bit more nimble and have been growing during this time frame. For a lot of other people, again, it's been 2021. I mean, people are turning deals away, right? And so some time frames, people will take almost any deal they can get their hands on, depending on the climate. Whereas again, then people were just saying, we can't take it. So investment banks, dealer brokers, they weren't able to take as many deals. The normal accounting firms that were doing work for particular groups weren't able, they had to prioritize, right? So which group am I going to choose? Am I going to choose to do sell side work or buy side work? So a lot of the firms that we kind of compete with directly, they moved a lot to the buy side because the buy side's a little more predictable. You buy the company, then you can get the audit and tax work as well.
Right.
Sell side's a little bit more one-off type transactions. But yeah, so it's, and so again, lawyers went through it. They went through a pinch. They had to turn work away. Accounting firms turned work away. And then private equity groups and family offices then weren't able to buy as many companies as they had desired to buy. And then again, because of the crunch of the time frame that, again, kind of being a false time frame, but everybody thought was pretty real, that kind of condensed everything as well. So, because again, we work with a lot of deal attorneys as well closely for referrals and just, does this make sense to you type things. And every one of those groups we've talked to, they're tired, they're burned out as well. So it's an interesting time right now.
Right. So, I guess what that really puts out there for folks is that they really, if you're planning a transaction, you better have you cannot assume that the professionals that you want to work with are going to be there, right? I mean, you really got to plan ahead.
100%. I mean, it's, before COVID, that wasn't necessarily the case. But in this time frame, it 100% is because, you may have worked with a group, an accounting firm or attorney for a time period, but maybe you haven't worked for them for 6 months to a year. Well, they may have already been, their time may have already been eaten up. I mean, we've even heard some of our larger competitor accounting firms have been put on retainer almost by some of these private equity groups to say, you're just going to work on our stuff when it comes in.
Wow.
So it's definitely, and again,
it's like they're reserving spots, right?
No, definitely. Definitely. Because again, you can't, those investors aren't going to let you close that deal without a quality of earnings, financial due diligence. That's part of the package that has to be done.
So I'm glad you mentioned that in that regard. So let's talk about the specifics of your practice. You mentioned a quality of earnings report. Let's as being one element of that, let's talk about some of the elements of the services that you offer.
Sure. Yeah. So it really kind of runs the gamut, right? Again, so on the tax side, we have people that can help with tax planning, SALT work, which is state and local tax. So, sometimes, for instance, if you're a distributor, you may be selling to all 50 states. You may be filing sales taxes in one state. Well, that doesn't really work anymore. And so a buyer, if they discover that, if they're the first one to discover that, they're either not going to buy the company or they're going to pay dramatically less for it. So we kind of help sellers prepare all of those things before they go to market to understand. The quality of earnings report is kind of one of the central pieces, and really it's just a fancy term for financial due diligence. Mm-hmm. It really focuses on recurring earnings, recurring revenue, kind of what drives revenue, right? How sticky it is. And by sticky, I mean do you have signed contracts? Do you have recurring customers? So all those things are things, buyers are looking for.
And this is really what you're getting at is, going ahead and dealing with all the difficult questions that you're going to get one way or the other anyway in a due diligence from a private equity group or whatever buyer. They're all the same when it comes to this. They're going to come in and do some pretty aggressive due diligence in terms of the questions that they ask. And so you need to be ready for that.
Definitely. The way I like to put it is you want it to be under friendly fire.
I like that.
You don't want the buyer to come in and be the first one to find it.
Yeah.
So again, that's the reason why, a lot of people haven't heard of a sell side quality of earnings.
Mm-hmm.
5-6 years ago is when it's, people were using it before that,
mm-hmm.
but now it's kind of becoming a standard. And the whole reason is it helps facilitate the deal and it gets the maximum amount for the owner. The other thing we found that it really helps is it takes a burden off their plate. Right. So a lot of times we can go into their own accounting systems, pull out the information and kind of take some of that load off of them.
Mm-hmm.
And then again, once a buyer comes in, they now have somebody to sit beside them and walk them through. Right. So a lot of times, there's a report, right? But the most value is the conversations that we have about deal structure and how do you want to look at this? Because again, these are founder owned companies. They may be spending they may be paying themselves $100,000, but there's another $200,000 in personal expenditures,
right,
bring to the company,
sprinkled through the income statement.
Well, now once that changes, once a buyer comes in, how do we think about that? How do we frame it? How do we show them? And so that's one of the things that gets put into a quality of earnings, right? So you have management adjustments and add backs, right? So you're trying to show what it's going to look like under the buyer's
mm-hmm.
ownership. And so again, that helps the seller or the business owner maximize value.
Yeah, that makes a lot of sense. Let's talk about when a business owner that's thinking about selling should bring you in. And I say thinking about deliberately because some of what you're talking about, you need some time to deal with some of these issues, right? And not just when you decide it's time to sell. So to that point, when should I start getting quality of earnings reports and acting upon them as I plan to sell?
Sure. So if you're a company that's never had reviewed or audited financial statements, that's something you need sooner than later, mm-hmm. right? If you've had an audit, somebody's at least sort of kind of kicked the tires on the accounting structure and the frame. But again, a lot of these companies have never been audited, never been reviewed. So when the information comes across for the first time, again, you don't want it to be somebody who's trying to find problems with it.
Right.
You want somebody who's going to work with you and help you develop. So, to answer your question, there's really not a time that's too soon. Again, we've helped some companies develop their accounting system and implement new systems as well, because if we can't figure it out and we're on their side, the buyer's not going to figure it out, and the deal's probably not going to go through, or again, you're going to get much less. So,
right.
The exit planning exchange is also a great place, right? It focuses on the same type of topics, right?
Right.
Getting people, because this doesn't happen as much anymore, but we've definitely had clients where they call us and they say, I got this letter of intent that I've already signed. What do I do now?
Uh-oh.
Right. And so, yeah, exactly.
Yeah.
Uh-oh, it's already way too late.
Right.
So but as the business world's gotten a little bit more intelligent, I think, around
mm-hmm.
M&A transactions,
right.
Again, less of that's happening. But that's how these, investment bankers and dealer brokers, that's how they make their money, is they go find these companies and
sure.
try to, represent them and take them to market. So,
yeah, of course. But for those that don't know, let's say you've got a company out there that they've got audited financials, and they might be wondering, why do I need a quality of earnings report if I've got audited financials?
Sure. So that's always a question I get almost every single time.
I'll bet
we go in. So the reason why is an audit, it's more of a compliance thing, mm-hmm. and it's outdated. So by the time you get your audit report, it may be 4 months after the information. Well, so the buyer wants to see the last 12 months, essentially. So that's one reason. The other reason is the audit has to stick to United States GAAP standards and gas auditing standards. That's where the quality of earnings starts. But then there's adjustments again, right? So if you're running personal things through the company, for an audit, it's an expense. For the quality of earnings, it's an adjustment. So that's where the quality of earnings can kind of help decipher, what's really, and then again, it provides a lot more information, a lot more granular information, right? Sales by customer, purchases by vendor, sales by type over time periods. So,
right. And if you've gone to recurring revenue, so an audit really doesn't get into recurring versus non-recurring revenue. It's just making sure all that revenue is counted correctly, right?
That's right. There may be some disclosures that give you some granularity, but again, it's usually on an annual basis, whereas the quality of earnings shows things on a monthly basis, typically over the last 3 years and then the last 12 months. So sometimes you can have, 47 months that are covered in a report. And so with that, you get a lot of trends and right, all the graphs unfortunately look the same over the last 3 years because they started well and then they crashed during COVID and then they've come back up. So, but again, it's just another tool to give more information to the seller and the buyer.
Do you think companies that really are pretty well buttoned up when it comes to having had done the work in preparing quality of earnings reports over time, does it make a difference in valuation, the ultimate valuation that they receive?
Yeah, definitely. Because again, the buyer has more confidence stepping to the table. So if you have more confidence in what you're going to buy, you're willing to pay a higher price. And so, sometimes when we do a sell side quality of earnings, a buyer will come in and they'll do their own quality of earnings, right? That's just their policy. Other times they'll come in and inspect our quality of earnings. Right. So again, that's another reason to have one on the sell side is, you may help again, alleviate. So again, if you can alleviate buyers' concerns on the front end,
right,
it always leads to a better valuation, a better price. And not only that, but closing the deal more timely, right? Because if you didn't have this and they keep finding things and you have to go back to the drawing board for another 2 months, whereas if when we're on the friendly fire side,
sure,
right, you can walk people through that process.
That's a great point because, we've seen this again and again where people, they sign that deal sheet and they're mentally now in Costa Rica at that point, right? And so they're not really necessarily ready for what's going to happen next and all the back and forth that's going to occur. And you want to minimize that back and forth.
Exactly, because, these buyers aren't just buying your company. So they have multiple deals at various different stages at one time. So if your deal, something gets interrupted, it kind of gets bumped back to the end of the line, right? And then again, whenever that happens, they're less and less likely to pay that initial purchase price that everybody thought. And that's the real problem, right? Is once everybody's seen a number.
Right. That's right.
If it goes down ever, it's always a problem.
Yep.
And so you're just trying to, again, alleviate as many of those things as you can on the front end. Again, and it doesn't solve every problem, but it just helps to kind of, get everybody on the same page on the front end.
Right. Jeff Hawkins is with us, folks. He is with Carr, Riggs and Ingram. He's a transaction advisory partner there at CRI. Jeff, I think our audience would be enlightened by maybe a success story, one that illustrates the great work that you and your team do.
Sure. So, interestingly enough, our best success stories are deals that go wrong, right? Because the deals that go right, that was the expectation all along.
Right.
Is that this company is what we thought it was, and it is legitimate. So, this story actually happened earlier this year. It was a deal up in Milwaukee, and it was a company that had a union. So there was multiple different issues with that from a tax perspective, right? And as everybody's heard of underfunded pension plans, well, that's unions, right? So so anytime you do a transaction, right, there's a stock transaction you can do or an asset purchase transaction you can do. Well, with a union being involved, you really can't you really can't pick and choose, because if you change the company, you have to pull that out of the union plan, re-enroll into the union plan under the new company name. But what that does is create a withdrawal liability. So however much that plan was underfunded at that time, you have to pay that liability. And so we were, our client was already down the road pretty far. They'd never worked with a unionized plan. We have a guy in-house that does a lot of union employee benefit plan audits. And so, it's not something that I specialized in, but I knew the person in our firm that specialized in it, and we got them moving on it and got their attorneys involved on the front end and basically saved them. I believe the calculation was about $6.7 million was going to be if they had just kind of gone through it the way they wanted to.
Wow. Something tells me they got a big ROI on their investment in you and your team and Carr Ingram.
That's right. And that's where, again, the report is nice. It's something to show everybody, but it's those conversations that we had with them to guide them in the right direction and put them in front of the right people. I mean, that's everything, right? Because again, if you got down to the closing table and then we figured this out, it's like, well, now what? Right.
Right.
And again, so maybe the deal dies or whatever. So, again, and then, one other quick story as well. Again, I kind of mentioned that, we're valuable on the deals that do die. We were working on one that was a contractor, and one of the things we always do is an OSHA search, right? Well, they reported to us that nothing had happened, right? There was no events or, well, we did a quick research on OSHA, found that there was a pending investigation, did a little bit more work, and found that a guy had actually, unfortunately, passed away at one of the work sites about a month before diligence started. And our client, who was on the buy side, the sell side company they did not inform anybody. And so we brought that to their attention. They brought it to their attention. The guy he finally broke down and said, yeah, this happened. And the deal died right there.
Wow.
Right on the table. And it wasn't because it wasn't a great company, but all of a sudden they didn't trust their new business partners.
Right.
And they were advised by somebody to do it this way, but it didn't matter to them. So again, that's not something that you would see in an audit. That's not necessarily something, right. It's not accounting based, but it's something that it's economic to the business. Right. So those things are the most important parts sometimes. Right.
Yeah, I mean, this is really a great lesson, or several lessons here. I mean, tell your accountant, your CPA, the truth, and so you can deal with the truth because it will come out, right?
That's right. And the deal would not have died if they'd have divulged it up front. All it would have done is maybe pushed it back for a month for the investigation to finish to see what the course of action was.
Sure.
And then we move along. Maybe we put money in escrow. But if you don't talk to the professionals, right, and trust their opinion on this, then, and this was the right buyer for them. Their top customer, the former CEO, was one of the investors.
Oh, wow.
And so it was the perfect deal for them, and they just blew it because they thought that was the right course of action.
So if I'm thinking about selling my business or, getting into that process, or maybe I'm pretty close to pulling the trigger on the process with a investment banker and with my CPA, can I hire you if I've already got my own CPA, or should I just use my CPA, my garden variety CPA that I have?
Sure. So, this is definitely a specialty. And so a lot of times they may be able to help with generalities, but the specifics of the transaction and walking you through different conversations, generally that they're not able to do that. So there's a lot of instances where we come in, there's already a CPA The other thing is if a company is audited by a CPA, you generally want a different CPA to do your quality of earnings report. Because again, it just gives another layer of sort of independence there and another check from a different perspective.
Right. This is why I take it. It explains why you're your own special group inside Carr, Riggs, Ingram, when there are all these other CPAs within the firm that do great work, but they're specializing in tax work or whatever, right?
Yeah, that's right. Like I said, it's, the working capital aspects, the business valuation aspects, right? Planning, tax planning. I mean, and a lot of times, and the investment bankers will tell you this as well, it's a psychologist's job as well, right? You're having to talk somebody through selling their baby and what that's going to look like. And, sometimes they roll over equity and then it's challenging for them. They're no longer in charge, right? And so a lot of times you being the CPA, you're kind of that person that gets a lot of those questions bounced off of you.
You're the transaction therapist, I guess.
That's right. That's right. Us and the investment bankers are definitely therapists.
I love it. Jeff Hawkins, folks, with Carr, Riggs, and Ingram. Jeff, this has been both informative and fun. So thank you so much for coming in. But before we let you go, let's tell everyone how they can be in touch with you.
Sure. So, really the best way to get in touch with me would be, via email. And so my email is the letter J, Hawkins @cricpa.com. I also have a fairly good presence on LinkedIn and would encourage you to reach out to me there as well for any questions you may have.
Awesome. Jeff Hawkins, Transaction Advisory Partner with Carr, Riggs, and Ingram. Jeff, thanks again.
Thank you so much for having me. It's been a blast.
Thank you. Hey, folks, just a quick reminder because we continue to love the folks at A&S Culinary Concepts. And yes, they do great corporate catering work. They have big green egg boot camps. They do private events. They've also got something pretty cool, and it's corporate team building. And if you want something, the corporate team building event that's unique, that doesn't involve sprained ankles and broken bones, here's a good idea for you. Call Andrew Traub. He's the executive chef there. 678-336-9196, and tell him what you've got in mind. Tell him about your group, and he can share some of what they do for unique and really fun corporate team building events. And I think you'll be glad you did. If you'd like to go to their website, it's ansculinaryconcepts.com. And folks, as we wrap up here, North Fulton Business Radio is the search term. If you would like to go find this show on your favorite podcast app, we'd be honored if you'd subscribe to the show if you're not already, and share the show. If you've heard something here that makes sense for maybe another fellow business owner or someone else that you think could benefit from it, we would love it if you would share the show. We're here to celebrate the great work of business leaders like Jeff, and we would love it if you would help us help them as we celebrate business and we act as the voice of business in this area. So for my guest, Jeff Hawkins, I'm John Ray. Join us next time here on North Fulton Business Radio.